So Jamie mentioned this paper by Boyd and Gertler, produced in the 1990s. I'm actually going to start a little bit further back. In fact, on a high note. It's a Wonderful Life. I'm sure that most of you are familiar with this movie. As the poster says, it's a gloriously life-affirming film. But for the banking geeks in the room, it's actually one of the best depictions of banking in Hollywood history as well. So I wanted to start with the movie. It's actually really an accurate description of traditional banking. If you watch it carefully, if you read the screenplay, I admit I've actually read the screenplay myself. One of the geeks. All the elements of traditional banking are there. There is a very nice description of loan making, a very erudite description of the whole maturity structure of the balance sheet of banks. There is a bank run, perhaps the height of one of the important parts of the movie. There are even ways to fix a bank run. For instance, equity injections to confront the run. When the George Bailey's wife takes $2,000 in cash out of her purse, the $2,000, they were going on the honeymoon, and those $2,000 are used at the height of the run to actually try to pay back the current customers of the savings and loan. There is even a bank examiner. So, I mean, there is really everything in here. Kind of a caricature of bank. I hope none of my bank supervisor colleagues are in the room. But the point here is that, you know how movies are remade every once in a while, especially the good ones. And so the question is, how would you do a modern remake of It's a Wonderful Life? And I think it would be actually quite of a struggle here. Because if you have followed the evolution of intermediation in the years leading to the crisis, I think we would have to have George Bailey's actually taking, it would have to be depicted as someone taking the construction loans of his bank and passing them through the whole alphabet soup of levered up non-bank investment conduits, vehicles, and structures, which is the definition of shadow banking that Paul McCulley so aptly gave at the 2007 Jackson Hole conference, right at the beginning of the crisis. So, this would be quite a challenge. Maybe we would have to change the title of the movie as well. I mean, not so much of a Wonderful Life right there. But what is the point that I'm trying to make here? The point is that the questions that a modern screenwriter here would have to pose in order to make a convincing remake are the same questions that regulators and students of banking have been asking in recent times. And they really revolve around the issue of how has financial intermediation evolved, who does intermediation, what are the entities involved in the process, and very much important for this institution, are the banks, the regulated intermediaries, still central to the process? And to what extent intermediation activity has instead moved really in the shadow? And so as Jamie was mentioning before, these are actually also the same questions that have inspired a quite broad research undertaking here at the New York Fed that I've had the honor to coordinate, 7 papers and 13 authors. And we published this undertaking in our journal in the summer of 2012. I encourage you to look at the website, to look at the papers. And we also blogged extensively. This is the link to the web page where you will see all the blogs. So I want to basically tell you a little bit about what were our theses, how we went about trying to develop our analysis, our findings, and what we think we have learned from these findings that can inform policy going forward. And in order to do that, let me really go back to George Bailey's depiction of banking. So in the traditional model of financial intermediation, the bank is really the main broker in the process of matching supply and demand of funds. Funds flow to this entity in the form of deposits, and they flow out in the form of loans. End of story, right? This is pretty much the textbook depiction of banking, unless textbooks have been revised in the last 2-3 years. And really, with this model, the locus of financial intermediation is the balance sheet of the bank. And that is the main justification for having a system of monitoring and oversight that is centered on these institutions, because the systemic externalities, which is really what we care for financial stability, this is a session on financial stability, the systemic externalities will emerge from the balance sheet of the bank. And yet, as I was hinting a few slides ago, what we have learned is that in the years toward the crisis, the model of intermediation has changed, and certainly has departed away from the balance sheet of the banks. Now, this matching of supply and demand of funds have been occurring more and more, increasingly so, along a much longer credit intermediation chain. This chart that I'm showing here to the right of the slide, that was so nicely, actually, this concept of credit intermediation chain so nicely developed by some of my colleagues here at the New York Fed. As a matter of fact, in your printout, there is an extra slide with some reference to it. And so the point is that in the traditional model of intermediation, loan origination was the end point. In the new, in the model of intermediation that is really centered on asset securitization, loan origination is actually the beginning of a much longer process where loans are originated to then warehoused and then securitized and maybe securitized again and so forth and so on. And so the point here is that as the technology of intermediation develops this way, new markets and activities emerge, and new entities also emerge to cater to specific intermediation needs at each and every step of this elongated credit intermediation chain. And so one view of the world is that essentially, intermediation moves in the shadow. The traditional entities, the banks, the regulated intermediaries, lose centrality. They become less important. Okay? And therefore, we also lose regulatory oversight of financial intermediation, hence a problem for financial stability. There is an alternative view, which is not necessarily alternative, it's a complementary view. I don't find this as being conflictual with one another. But what we suggest, actually, in our study is that, in fact, we should at least allow for the possibility that the incumbent institutions, the regulated banks, have a way to adapt to this changing technology of intermediation, and they adapt by essentially change the way in which they cater to the needs of intermediation. And by doing that, and that's, I will be more specific in a couple of slides, by doing so, they remain actually an integral part in the new model of intermediation. So why is that important? I think it's crucially important. It's incredibly important because it really makes a difference in terms of the monitoring and regulatory approaches that you may want to take, whether in fact we establish that shadow banking is something that develops independently of regulated bank entities, or whether instead banks and shadow banks are intimately connected. And so if you are able to address these questions and try to provide some answers, then hopefully you can also address the bigger picture questions that are on the table and keep regulators very much entertained recently. So if indeed it is the case that intermediation moves away from regulated intermediaries, should we expand the boundaries of regulatory oversight? This is, in a way, the approach that on an international, in an international setting is currently undertaken by the Financial Stability Board. But we should also take into account that, it's a moving target. Regulation itself may spur growth of new shadow markets and activities. So how do you do that? How do you monitor new mutation in the system of financial intermediation? And to go back to Meg's presentation before, I mean, how do we stay at the same pace with the development in order to call the problem before the problem presents in front of us? And so then the last point is probably the big question. Don't ask me questions about that. But if intermediation is done outside of the regulated entity, should we extend the scope of government guarantees? right? At the end, if it is a public, if the public externalities are substantial, we should take a public approach, right? And we're not talking about nationalization, by the way. So these are the questions that essentially we bounced at each other as we were, undertaking our analysis, our research, and we came up with a framework of analysis based on two separate but complementary elements. The first is that we actually focused on the roles that were needed along the intermediation chain. So the map of credit intermediation that is shown here, this is the credit intermediation that focuses on the steps: loan origination, loan warehousing, securitization arrangement, et cetera, et cetera. This is very important to understand how the system has changed, but we thought it was actually important to focus on who are the entities providing the services, the intermediation services at each and every step of the chain in order to allow for the securitization-based intermediation to take place. And the reason why we thought that that was actually a very important thing to do was that by focusing on the entities that emerge along the credit intermediation chain, we could perform, and I think we did it for the first time, we could perform a quantitative assessment of who is doing what in modern intermediation, and so really address the fundamental issue: what is the role of the banks, of the regulated entities, and what is the role of non-regulated entities in the process. And so we came up with an alternative map of financial intermediation that again focuses on the role. So between supply and demand of funds, we really focus on the main characters that are needed in order for this process to be completed, in order for the process of asset securitization to be completed. And so besides loan origination, you need to have issuers of securities. You need to have underwriters that place those securities in the market. You need to have servicers that are essentially managers of the income flow from the underlying loans. You need to have a trustee, which is a sort of a delegated agent for the ultimate investors in the securities. And probably you need to have some form of enhancement, some liquidity and credit guarantee to boost the quality of those securities as well. And so this map is really morphologically equivalent to the one that I was showing before, but again, it really stresses the importance of the roles of the functions rather than the steps. So that's the first element of our framework. The second one is that we really wanted to push the envelope on this idea of entity-based analysis, and we wanted to focus on this possibility of adaptation by the banks, by the regulated entities. And so we wanted to explore essentially the idea that banks may adapt through organizational changes by essentially expanding the boundaries of the banking firm from an industrial organization perspective. And by doing basically what? Incorporating those non-bank specialized intermediaries that are emerging in the, along the chain under common ownership and control. And so our intuition was that, in fact, in order to understand exactly how the process had evolved, we had to shift the focus from commercial banks, which is what we've always focused when we have been discussing banking per se, to bank holding company, more broadly defined. And so in order to fix this point with an image, if I go back to my picture before of how the system of intermediation moves away from the traditional line, so this is the shadow system, but more specifically, what is the shadow system made of? It's basically composed of all those entities, again, that I was mentioning, emerge to cater to the needs along the chain: specialty lenders, underwriters, broker-dealers, guarantors, asset managers, and so forth and so on. And so the point is that we should at least allow for the possibilities that all these entities could be incorporated under common ownership and control of bank holding companies. And I think that this is actually a very important point, because at the end of the day, do not forget that the Federal Reserve System is actually the regulator of bank holding companies, not just the regulator of commercial banks. And so by understanding, assessing to what extent intermediation has evolved and the role of bank holding companies has evolved at the same time, it really tells you something about the shadiness, if you will, of the shadow banking system. And I hope you appreciate my little PowerPoint thing. That's not by accident that I have a shadow there, right? I mean, wow. So this is the takeaway. Essentially, yes, bank holding companies have been evolving a lot. And at the end of the day, regulated bank entities have remained very much in the center of the modern system of financial intermediation, either providing direct roles or providing support to credit intermediation, and through this organizational adaptation concept that I was mentioning a second ago. So let me lead you through a few slides to summarize the different contribution in our journal. Back to the map that I showed before. So for instance, one of the articles that I wrote myself with my colleague Stavros Peristiani took literally the universe of asset-backed securities down at each and every individual security that was ever issued from the beginning of times. And for each and every one of them, we were able to identify who performed the trustee, the underwriter, the issuer, and the servicer. And when we did our counting and we aggregated, I'm just showing you here a big cross-sectional aggregation. We have all the details in the paper. The yellow section in the boxes is basically the percentage of services that were provided by bank holding company related entities. And so actually, when you take the union of the different roles, there was hardly ever any securitization activity that took place in this space of asset-backed securities that took place without a bank holding company providing at least one role. So bank holding companies literally all over the map of modern financial intermediation. And also, the focus on loan origination, for instance, was the main subject of another article by my colleagues João Santos and Vitaly Bord, who is now in graduate school. They focused on loan origination, and they confirmed that, as a matter of fact, banks had remained also central entities in originating loans. And in fact, as they were input feeders into the chain. In fact, providing the important elements for modern intermediation to develop. And at the same time, also, as my colleagues Mandel, Morgan, and Wei showed, they also maintain a very important role in providing guarantees. So if they were not doing it directly, they were essentially providing those enhancement services behind the stage that were allowing the process of intermediation to take place. How much time do we have? Sorry? 20?
That's all right. We can have time for questions.
All right.
So that's
I guess
great.
I was going very fast. Well, let me slow down. So let me show you a few. No, actually, I have a few more slides. I know at the end I will be consuming all my time. So some facts, in fact, on the boundaries of bank holding company. This is a snapshot in 2011. Data that we were able to collect, not so easily, as a matter of fact. Bank holding companies in 2011 control about 38% of the assets of the largest insurance companies, for instance. Roughly 41% of total money market mutual fund assets. And approximately 93% of the assets of the largest broker and dealers. These are all entities that you hear all the time when there is conversation about shadow banking, right? And so I think that's probably an interesting stylized fact. And also, there is very little securities lending and related cash collateral reinvestment that take place without the services provided by the main custodian banks. So that's, I think, it is an important stylized fact to show again that you can't just perform the analysis taking these entities, the incumbent intermediaries, as unmovable, as they would not change and try to adapt to the system. They seem to have done it quite well. This is another picture that it's a table from another contribution from my colleagues Abraham, Selvaggi, and Vicari. This is another snapshot in 2012 that tries to give you some more details about the organizational structure of the top bank holding companies. I don't know how well you can see here, but again, the printout should help better. Here you have, from top to bottom, the largest bank holding companies, JP Morgan Chase, Bank of America, Citigroup, and so forth and so on. And then the column, you have the number of subsidiaries that are folded under each and every bank holding company. The first of the columns there is the number of domestic commercial banks. For instance, JP Morgan Chase has 4 commercial banks, and it has about 2,000, almost 3,000 non-bank subsidiaries as well. And when you incorporate foreigns, we are well past 3,000 overall subsidiaries. And commercial banking, again, by number, not by assets, of course, are just a very small number. And the same is true for the top bank holding companies. Now, you're saying, well, that's just a snapshot in 2012. You're cheating. You should show us a little bit of an evolution. So here's a way to do it. This is comparing 1990 with 2012. On the horizontal axis, you have the ranking of bank holding companies from largest to smallest. And on the y-axis, the number of subsidiaries. So the blue columns is the cross-section in 1990. The red columns is the same cross-section for the top bank holding companies in 2012. And so this picture, I think, suggests, again, that there has been an evolution that is compatible with this story, with this idea that, in fact, bank holding companies, the banks have been expanding the boundaries of what constitutes the banking firm. And you can look at it also from the perspective of the bottom line. Where is the income coming from? This is analysis from call report data focusing on the income statement. And these lines are showing you the contribution. This is from another paper, Copland, also in our EPR issue. The lines here are showing the contribution of commercial bank subsidiaries to total income of the bank holding company. And you can see, especially for the largest bank holding company, the green line, the contribution to income of commercial bank subsidiaries has been on a steady decline throughout the years, coming to the crisis. So the non-bank subsidiaries, the role of non-bank subsidiaries in providing income has increased. Another way to do this. This is a table that shows pretty much the universe of mergers and acquisitions that have taken place in the financial industry as a whole, not just banking, financial industry as a whole. The way to read this table, this is a two-way matrix. Here on the rows, you have the type of buyer, asset manager, bank, broker-dealer, and so forth and so on. On the columns, you have the type of target. So you have, for instance, here, whether an asset manager is buying another asset manager. Okay, you go here on the main diagonal. And same thing, a bank buying another bank. Everything is filled here on the main diagonal. What I think is interesting of this table is to show the off-diagonal dynamics. And this is really showing, you can look at it more in detail when you look at your printouts, that in fact banks have been very active in buying up lots of these non-bank subsidiaries, asset managers, broker-dealers, and so forth and so on. Okay, you can see here the raw totals. This is done by number of mergers and acquisition. If I were doing it by dollar assets acquired, the picture would be pretty much the same. And there is another slide in your printout that gives you more details. So let me sum up. So it is undeniable that this modern system of financial intermediation has grown much more complex than we knew at the time of the George Bailey's type of bank. And there are now many more entities, certainly, that are involved in financial intermediation that are not banks as we know them, commercial banks. And certainly, the risks have moved away from banks' balance sheet. And so, again, these are all the obvious points. There are very important monitoring regulatory implications. These are the big questions that I was posing before. But this is the bottom line of our humble contribution. And it is that when you look closely, actually, the modern financial intermediation to us seemed less shadowy than we thought. At the end of the day, really, the regulated bank entities have kept a very important footprint in modern financial intermediation. And that ought to tell us something, should teach us something about how to go about doing monitoring and regulatory oversight. And so I leave you basically with what I think is the really important question that I was hinting at it before. OK, so we can do retrospective analysis, and I can look very smart by telling you how intermediation has evolved, like a good Monday morning quarterback, right? Really, the difficult part is how do we track the future evolution, right? So we recognize how the system has evolved. We take, we apply what we think are the appropriate fixes. What do we do next round? How do we recognize the next list of mutation, of changes? And again, regulation may be a source of future developments of where the risks are, okay? And so our analysis is that if new products or activities emerge, there is a very good chance that a bank, a regulated entity, will still be part of it. In other words, we are really stressing this element of natural adaptation by this entity. So we should not discount this element, but we should not discount it really from the perspective of how to inform regulatory and monitoring, because essentially this might suggest a tool for effective forward-looking monitoring. Follow the banks. I'm making a little bit of a statement here. It's really that the monitoring of banks can still provide us with an effective window into the evolution of financial intermediation. And so we can learn a lot by looking at what these entities are doing on their balance sheet, off their balance sheet, through their subsidiaries. So there is an important element of information that perhaps has been not fully exploited in previous years. To credit of my colleagues in bank supervision, they do recognize the importance of bank holding companies in the process. They even changed the name of the group. It's not bank supervision anymore. It's financial institution supervision. So they are really emphasizing, again, a much broader approach to understanding the risks. And right, so I leave you basically with this last sentence. What we have done, I think, really stressed the role of bank supervisory agencies for effective forward-looking monitoring. And I think that's it.